Investor with Julia Lee.
Welcome to the show. On tonight's program, CBA shares up 1.5% following a $700 million penalty agreement between the bank and Austrac. And baby food producer Bubs Australia sees its shares jump 7.84% today following a lucrative agreement with Chinese distributor New Times Asia. And in our stock in a minute, we'll speak to Morgan's advisor Jin Finlay about Australian tailored packaging solutions company Aurora. And my guests tonight are Michael Wayne from Medallion Financial and also David Manchi from Belvedere Share Managers. Don't forget, you can also reach us, eq@skynews.com or hashtag equity investor. And if you want to ask your question live on air, just include a contact telephone number and we'll call you right back. Well, let's talk about some of the news that has been making headlines today. And we have to talk CBA, the biggest civil penalty in Australian history on the cards for the Commonwealth Bank, with Austrac and the CBA coming to terms on a $700 million penalty to be paid by the bank, along with a further $2.5 million in legal costs. The agreement centering around CBA's breaches of anti-money laundering and terrorism financing laws, all but a done deal, with CBA Chief Executive Officer Matt Comyn saying the agreement brings certainty to one of the bank's most significant issues they were facing. And adding, while they're not deliberate, we fully appreciate the seriousness of the mistakes we made. Our agreement today is a clear acknowledgement of our failures and an important step towards moving the bank forward. But let's take a look at Commonwealth Bank. You know, some viewers out there might be wondering, $700 million fine and the stock jumps 1.4%. What is going on there? Michael, what do you think?
It's hard to know exactly. Obviously, we had some strength in the market more broadly today, so it could be that. It could also be the fact that it now clears up one of the overhanging issues for the new CEO, so there's a bit of a wiping of the slate and a clean start there. So that's potentially what the market is seeing. Obviously, the CBA has been under enormous pressures, broken below $70, is sitting on that long-term support level. So there's a number of reasons why we could have seen that bounce that we saw today.
Have we seen peak bad news for CBA?
Look, I still think we've still got the Royal Commission findings to come forward. I'll be tempted just to hold off a little bit further. There are a number of headwinds still facing the bank from a revenue perspective, but they are certainly looking a lot more attractive now than they have in a number of years, and we are keeping our eye open.
I mean, David, one issue is the regulatory issues which are facing the bank, and obviously these fines now with the BBSW and ASIC and now Austrac. But the other is the cyclical nature of the banks and the housing market. And we haven't talked a lot about the Melbourne.
That is the elephant in the room. But you've got to admire Matt from CBA saying he's happy to put it behind him because he was in charge of that division. Now you go across to ANZ, they'll be pretty happy to settle their issue as well, because the current CEO is the ex-CFO when they did the deal for the equity raising. So there are some personal issues here involved at a very high level. So it's in everybody's interest to settle.
Would you be buying CBA at these levels?
Look, I think that unfortunately, I think most people's super funds have got them, or have got banks, and you have to hold them now. Unfortunately, they look dreadful. It is just they just cannot find a base, and they keep getting hit with more and more bad news. And unfortunately, you know, it's hard to see the end of that. You keep thinking that it's going to sort of base out, but it's gone further. And so you've seen the continued outperformance of a lot of the other sectors, including resources more broadly. And it's tough. It's tough for shareholders, and they're the ones taking the brunt of a lot of these mistakes.
Michael, would you be buying?
No, not just yet. I'm still very cautious, not only on the housing market, but where's the revenue growth going to come from? I also think what we saw from today's announcement is the risk management implications and the compliance implications from a cost perspective. CBA have come out and said they've spent $400 million just trying to clean up this area of the business. They've had to also have an undertaking with APRA whereby they've put aside a certain amount of capital, which they now can't go and create mortgages and create debt on. So I think it's going to have an implication on their bottom line as well, because they're going to have to change their focus away from sales to more risk and compliance.
Okay, let's go to our first email of the night. This one comes from Neil in New South Wales. Do you see Pilbara Minerals as a good buy? Having a look at Pilbara Minerals, look, they've had an offtake agreement with China's Great Wall Motor, and just recently with POSCO as well. And POSCO bought shares in the company at 97 cents, and today the share's finishing at 91 cents.
You know me, I love lithium. I actually bought more on last week. I thought the reserve upgrade was good. So there's definitely a seller there in the market that seems to be capping it. It's been just going sideways around this 89 to 92 cents for the last couple of weeks. My sense is that once that's expired, it will pop. It's lagged the others, and the registry is still pretty open. So I think it's from a trading position, pretty good buy.
Okay, so liking it, David. Is it your favourite lithium company? You said you like lithium.
No. My personal largest holdings are in Galaxy, and I've also got a lot of Ora Cobra. I own Tawana, I own a few of the early explorers. So, I think I haven't owned Pilbara before, but like I said, I bought them last week.
Okay, so David's been accumulating positions in lithium and has a whole portfolio of a lot of the producers out there. What's your view on lithium and Pilbara Minerals?
Look, more broadly speaking, we find it to be a very volatile space and treat it more of a trading opportunity. Obviously, the long-term story with electric vehicles makes a lot of sense. We've played it through the producers, primarily Galaxy. They had probably some of their best news in recent times, I think a week or two ago now, with the Sol de Vida project where they sold off a portion, which should create some funding to now go develop their resources. When it comes to Pilbara, obviously they're looking to make the transition into a producer. They've got a very high quality asset, very low cost of production, potentially once it comes into effect. The big question is whether or not that's already been priced in. And there are added risks you don't really have with Galaxy in terms of the development of that mine and the whole production costs and things like that, whether they have construction blowouts and those sorts of things.
And I guess a near-term catalyst, David, might be stage 2 approval, which is due in the second half of this year.
Yeah, look, I think they're going into production right now. So let's get through the first step. They've approved their feasibility for stage 2, and they've now got the funding through POSCO. They haven't got all the off-takes. They've sensibly held that back for stage 2. But right now, hope it should. From everything they've said, it should be in production very shortly, like it's in June. So then the next catalyst will be stage 2 and what agreements they can come up with there.
Okay, so unlike CBA, Pilbara looking pretty good on the market. PLS is the stock code there. Our second email of the night comes from Greg, and he asks, is Costa Group fair value with its growth prospects? Berries, tomatoes, avocados, mushrooms, the stock hitting an all-time record high. So any investors holding Costa Group, breaking open the champagne tonight, because it's been one that's flown a little bit under the radar, but it's been a top performer on the market. Having a look at Costa Group, David, what do you think?
I don't know if it's been under the radar. It's just been vertical, hasn't it, really? And look, there's a lot of us have probably looked at it early on and then sort of, we'll see how it sort of settles down. We'll wait for a pullback, and it just hasn't happened, really. So good on the shareholders that have ridden the wave. I sort of think sometimes, though, that with these things, you've got to keep in perspective the risk. This is intensive farming, and intensive farming does have risks with disease and with other problems. So, agriculture I'll be in and out of different things. I tend to like to buy them when they're out of favour. Obviously, right now it's in favour. Very well-run company, though, so if you have them, good luck to you.
David has a really good point about the intensive farming part, and the part that's so fascinating about Costa is, unlike the traditional methods, they're looking at producing 12 months of the year. So they've got these glass houses, I guess, or hydroponics that produce all year round. But a lot of their story is also international. So at these type of levels, Michael, would you be happy buying?
Look, it's hard to argue against it, given it's got such strong momentum in price and the business seems to be forming very, very well. I've got a handful of clients in it, wish I had more. It's a bit hard psychologically at these levels to jump in, but as you say, they've got a vast suite of different offerings that they're looking to provide and supply to the market all year round. And all the new volumes that are coming online now are really being absorbed by that strong demand that's coming from overseas. So if I was holding it, I'd be very much tempted to hold. In terms of putting new money to work, it is quite difficult at these prices, and I'd be tempted to wait probably just to the August report now just to see what comes forward before making that decision. But more of a hold, wish I had more money in it.
So they're forecasting 25% growth in net profit after tax this financial year. And for their new projects, I think they try and aim for about 20% return on capital from an earnings measure, Costa Group. So it's been a great story. Hopefully it continues. Straight to our next email. This one is from Kurosh in Sydney. Could I have some of your thoughts on Insurance Australia Group and if higher US bond yields can help their revenue? A great question coming through, because we are seeing higher bond yields, and both QBE Insurance and Insurance Australia Group are, I guess, the two insurers that get the most out of their investment portfolios. QBE more than Insurance Australia Group. But have a look at the share price of Insurance Australia Group. I mean, Michael, it trades at a premium because it's been increasing margins. It's been doing extremely well. Would you be buying here?
Look, it's not a business model I like. Insurers, they tend to be quite volatile. It's going through a positive phase at the moment, and it's had a very good track record compared to the other insurers here in this country. I think what's also been in their favour recently has been the improving premium prices. We've seen premiums really pick up in this country after it was a couple of years of strong competition, which was putting downward pressure on premiums. They've also, I think, de-risked their business model with an agreement they've got with Berkshire Hathaway. So I would be tempted to hold it if you've got it, but again, insurers aren't the sort of businesses I like. But yes, a rising bond yield environment will certainly be a help for them, because what they do is they take your premiums, they then reinvest those premiums at rates now that are going to be higher, so the investment returns should come through more positively for them.
It's a brave person that bets against Warren Buffett, and of course Berkshire Hathaway with a 3.7% stake in Insurance Australia Group, and also the option to acquire up to 20% over the next 10 years. Having a look at this stock,
yeah, but it's typical Berkshire Hathaway investment. What they made is they took an option on the upside, and they were really going to make their money out of the initial transaction that they did. So I wouldn't pay too much attention to that, because it didn't really cost them anything to get that option. So I think what I underestimated here was not own IAG for the reasons that Michael mentioned about the industry, is that they've had weak competitors. So that's really helped them in Australia with the premiums, and in particular with QBE. QBE is in the doghouse globally. So if you looked at share price, it's the reverse of that chart there. And Suncorp Metway's had its own issues as well, which is another major competitor in general insurance. So that's really helped IAG.
Would you be happy accumulating at these
type
of prices?
No, it's not for me.
2 no's from our panellists. Our last email of the day comes from Doug in Melbourne. Could the panel comment on the progress of THC Hydroponics Company? So in the area of medical cannabis, and I see David's already having a giggle. What do you think of this one?
Oh, look, when I was at uni 30 years ago, I would have been interested in this products, but no, not as an investor.
So looking at medical cannabis, and I guess a couple of years ago now, the legislation in Australia legalised medical cannabis. They still are yet to get one of the licenses they need, so they have 2 out of the 3 in order to be able to do the development, growing and marketing. Any thoughts on this space and how
It's not a space I'm
THC?
that across. It is obviously very speculative at these early times. I think with THC, it's more of a cultivator at this point. If I was probably going to go down this path with this industry, I'd be looking for those companies that are more specialised. They're looking to get products approved. So Botanics is one of them. They're looking to come up with something that can be used for acne treatments, for instance. There's others as well that sort of have more targeted focuses. So that's probably the way I'll go down.
I mean, a lot of parents would be laughing out there, having their teenage kids with acne putting medical cannabis. Anyway, coming up, David and Michael's buy, hold and sell, and our stock in a minute. Stay with us.
You're watching Equity Investor on Sky Investor.
Now introducing Jen Finlay, who's an advisor at Morgans, in our stock in a minute.
The stock I'd like to introduce today is Aurora. It's a packaging company with about 65% of its business in the cardboard space. The other parts of the business are aluminium cans and wine bottles. Australia saw record exports in 2017 of wine, especially into China. The company is rolling out SAP platform into the US, and it's about 80% complete. We expect that this will be completed by the end of August, and that then frees up management to look at acquisitions. If they apply the same rigour and discipline that Amcor, their previous parent, would apply to a takeover, then you're looking at a 3-year, 20% return on equity. We believe that the market will then re-rate the stock. The current...
I mean, it sounds so boring, Aurora. It's a packaging company, but it's one of those boring businesses that is producing results. It's really hard to find a company that's looking at growth through acquisition at the same time growing organically. But, to me, it seems like the Australian-New Zealand part is the exciting part of its business at the moment, and in America it's probably a little bit more challenged. I mean, Dave, you said it's boring. What do you think of what else do you think? Why do you think it's
Going to
boring?
sleep. No, look, it is a good business, but it's capital intensive. So, your returns on capital are actually quite low, despite what was just said then. So you actually want to buy it at the right price. And to me, it's actually trading above where it should be, and both from a fundamental perspective and a technical perspective. So, yes, great long-term business, very well established, multi-jurisdictional. But it's also, from an investment perspective, you're only going to buy it if the price is right.
I mean, I'm quite amazed that it's up 18.5% over the last 52 weeks. So it has been a steady performer there.
I think because of that reason, though, because people have been looking for things in their portfolio that are lower risk, and then because with the volatility in a lot of other sectors. So, and it's obviously got, looking at, so I think for that reason that, it's done well.
And I think David's right. It is very hard to find stocks in your portfolio that offer you those defensive characteristics and haven't been sold off hugely. I mean, utilities have been sold off, property's been sold off quite heavily as well. So, I mean, Michael, it's gone white, so I feel like you're going to say something really important here. What do you think of Aurora?
Look, we like Aurora and have held it for a year. And for those exact characteristics, it is a conservative position in the portfolio. You're probably going to get your growth in income and dividends over time. They've got a very good market position, 65% of the beverages bottling industry here in Australia. They're in a duopoly, junior partner with Visy in the more sort of cardboard boxes and what they call the fibre division. And they are making efforts to expand into the US, where obviously it's a far more fragmented industry and they're only going to ever get a very tiny market share. But if they can get 1%, 2%, 4%, then it can make a meaningful difference to them. So it's a business that we quite like, and the industry overall is seeing improved margins because the technology's improved a lot and they can bottle things in these very interesting ways. Almost they can fill up the bottle as they're making the bottle. So the technology advancements have improved and industry margins have picked up a lot, which has helped them. Okay,
we only have a couple of minutes left, so on to my favourite part of the show, and that's buy, hold, sell. So Dave, what are you buying?
I think base metals, continue to buy them. So your Independence Group for your nickel, Western Areas as well for nickel, Metals X, which gives you the tin and copper, Western Areas. So any of the base metals, obviously lithium stocks, stick with your resources, BHPs, and hold those.
So resources powering along the earnings of the market, and David's still liking them. How about you, Michael?
Speedcast Global, this was a buy I had going back a few months, but I thought I'd bring it back because it's had a bit of a retracement in recent days. Basically, they provide data services to industries that operate in remote locations. So think about oil rigs, for instance, and that's potentially why we've seen the big pullback in share price, because the oil price has come back a fair way. But it also services a lot of the shipping industry, the cruise lining industry, and they've been winning a lot of new contracts which are starting to come through for them. So that's one to buy the dips with.
It's an interesting one, interrelated, because as the resource boom happens, you see greater need for those type of services. What would you be holding, David?
Oh, most of the market, I suppose. If you had Aurora, you mentioned that. Definitely BHP. As I said, if you own the banks, hold those. There's a whole lot of stocks that are reasonable value, and there's no reason to sell them. So pretty well across the board of the majors.
Okay, I feel like the Australian market has missed out on a lot of the international rally. So Australia as a whole, a little bit of a hold. And how about you, Michael?
Shriro Holdings, which recently came into some pressure due to a 15% profit downgrade. But the update itself wasn't too bad. This business has a 10% dividend yield plus franking, trades on about 7 times earnings. It distributes consumer products like Everdew kitchenwares, for instance, Everdew barbecues, Casio watches. So it's quite diverse, but it's looking to expand into the US and try and capture a small fragment of their barbecues market. So the commentary has so far been quite positive, despite a downgrade in what's more their mature business. So we feel as though the market's valuing this as a very mature business, but it's underappreciating some of the growth potential there.
Interesting one. And sell from you, David?
I own WiseTech, I think it's a great company, have owned it. I actually think, though, it's completely lofty levels now. 19 acquisitions in the last 12 months is, to me, I don't see how you can bed that down. So I think the risk from an investor's perspective is now right up there. So if you had WiseTech still, congratulations, but I'd be taking some off the table.
Okay, WTC, and how about you, Michael?
Metcash is a sell for us. It actually was at 3-year highs until it had an issue a week or so ago, losing one of their main partners. So I think that long term, the foreign entrants coming into the market are really going to put pressure on them, so to sell from us.
And that's it. We hope you've enjoyed the program tonight. A big thanks to my guests, Michael Wayne and David Manchie. Michael Wayne from Medallion Financial and David Manchie from Belvedere Share Managers. A reminder, you can watch the show anytime with Catch Up on Foxtel Go and on demand on Foxtel IQ. We also have a podcast which you can find at skynews.com.au, and if you're overseas, we're available on demand on australiachannel.com.au. I'm Julia Lee from Bell Direct. Thanks for your company.
Information presented on this program is general in nature. Viewers should